Today we're going to look at what's needed to create successful mechanical trading systems. There are steps to be taken toward making your systems reliable rather than misleading. One of the troubling realities is that it's much easier to churn out good-looking numbers in a performance summary than it is to create, you hear this word a lot in research, robust systems that will stand up under different conditions and work for you roughly the same in your actual trading life as they did in the theory. The two are much different. Now, fortunately for us, there are ways to pretty much assure ourselves that we're happening upon actual biases that will persist rather than just fluky short-term runs that don't mean much. And we're going to go over those steps. And then we're going to look at one of the most basic types of mechanical systems, the moving average crossover. It's one of the simpler systems, simple to code, simple to trade. You can often just enter a trade off eyeballing a chart without any kind of math computations or whatever. Okay, it's classic and it works. That's the thing. All right, first a little bit about me. Been a member of the Chicago Board of Trade for over 36 years. 1986, I developed my first successful trading system in the T-bonds, and I discovered that by going over microfiche in the library, Wall Street Journal pages. I'd have to find the market page in each day, and I'd just keep going forward with this very basic idea, and it was work that most people would consider drudgery, but I just couldn't wait to get to the next day to see if this was panning out. So I filled a notebook full of entries, exits, and then after I had several years, I did a second notebook, compared the two, took out the mistakes. I just say that by way of telling you that I'm very meticulous in what I do and very committed. Some might say obsessed. I walk the walk. I've been trading ever since. System success has a way of begatting, more efforts to find other things that work. And for a while, I was trading markets in just about every sector. I wanted to augment this kind of success with pit trading. I just wanted to immerse myself in all kinds of market activity. I was working in a job that I didn't like and was intending to quit it. Bought a seat on the Chicago Board of Trade, went down there and was hoping to augment my system trading success with pit tactics. What I found to my chagrin, what I think most people find when they do this, trying to combine the two gives you the worst of both worlds. You're either 100% mechanical in your approach or you're not mechanical at all. I'm the author of 4 full books on trading, and I've also put out 5 yearly almanacs that reflect the original Beating the Financial Futures Market that I published in 2006. All of them have standalone information not found in the other periodicals. I've done lectures across the country and beyond, and in recent years just done a ton of stuff online. You can go to Art Collins Trading and find all kinds of interesting biases, systems, etc. Now, my Trading life can be broken down into two major categories. All my aggregate successes come from strict mechanical rule-based trading. I know exactly when to enter a trade, when to exit it, where to put stops. Nothing is open to question. All my disasters, meltdowns, foibles, restarts came from everything else. So I'm a study on both sides of the equation. You would have thought that clearly knowing which side my success comes from, I would have learned the lesson early on, but sometimes I have a very thick head. And again, I'm not different than 90 to 95% of the traders who lose money to the remaining minority. And personally, I would put that figure much higher. Since most people are neither systematic nor mechanical, and most people trade according to whatever whim strikes their fancy at the moment, you do not want to do what most people are doing. Stands to reason. It's a good way to land yourself in the typical loser pool. Meaning what? Meaning that the trades that feel really good to us, our instincts, our gut, we're just wired wrong. That's the short answer. Human beings are wired wrong, and we'll get into that in a little bit. They're wired wrong to make money at this endeavor. Why is that? Basic reason is that people are resistant to taking losses, and they fear giving back unrealized profits. The culprit is our memories. If we've traded any length of time, we remember trades where we had our stop at the worst possible place. We're out of the trade, and then it goes back into the winning territory where we would have made money. Ugh, next time I'll widen the stop. Next time, God forbid, I won't use a stop at all. Or we're riding a winning trade for some time, only to have it give up ground, and we wind up closing it out a loser. We don't want to do that again. Next time, we'll get out earlier before we give back money. Well, Trading 101 tells you that this is 180 degrees opposite what you should be doing. The prime directive in trading is let your profits run, cut your losses short. To do that, we have to overcome our natural inclinations. People also attempt to impose order where there is none. There's a small trending component that allows mechanical trading to work. It's discovered over a large array of trades. Individual trades, or a small number of them, mean nothing, okay? We can detect it over a large amount of trades. But most of the market movement is just random noise. It means nothing. So people want to see patterns where they don't exist. We all have seen the textbook examples of head and shoulders, tops and bottoms. You know, I challenge you next time, if you want to be hard-nosed in this, look in the middle of the page. See if you can identify what might have been taken for a head and shoulders. But rather than bracketing the trade and reversing the market direction, it just kept going. We have to overcome a lot of deceptions, okay? People also tend to lose sight of the only reason to trade, which is to make money, which should be a no-duh, right? But people actually trade as a proving ground to themselves, to a family member. They trade for revenge. This market owes me, and by cracky, you know, I'm going to make it pay. No. Money. If you're making it, you're doing it right. If you're losing, you have to change. The biggest problems, and I have all kinds of personal anecdotes on this, arise in trades in which people are the most comfortable, complacent, and confident. it kind of is reflected in an entire book I wrote called When Super Traders Meet Kryptonite. It was a book about spectacular trading losses from big shooters who risked far more money than us everyday folk. And they got in in some cases, series of trades that threatened their very careers. Well, there's certain commonalities to all these individual stories, and one of them is these bad periods tended to come on the tail end of especially good market run-ups, good account run-ups. As they were flying high, they would say things like, I had a walk on water complex. I felt bulletproof. I suppose, it comes down to, it's at that point that the guard gets lowered a bit or whatever, carelessness. But trades that seem like they should be easygoing are where troubles tend to come from. I guess I missed the one above that. Trades that we fear tend to pay off the most. Lots of anecdotes for that too. During the Black Monday crash of 1987, I came in short the S&Ps over the weekend leading into Black Monday. Made a lot of money right on the open. More money than I'd ever made on a trade before by far. And my systems were telling me to get long the bond market. Well, I had no experience with flight to quality at that time. And that's the last thing in the world I wanted to do. Well, bonds locked limit up for 2, maybe 3 days. I was happy with that trade also. All right, mechanical trading bypasses emotion and natural psychological wiring. Since we've identified our biggest stumbling blocks as stuff that is related to psychology, it stands to reason that the way to overcome that is to completely take ourselves out of the trades. That's what rule-based trading, based on past research, does. You can still continue to feel a certain way about your trades, but if all you're doing is throwing the switches, it's not going to matter. You're not part of the equation. Mechanical trading imposes accountability and discipline in following trading rules and working toward goals. That's the thing about having your performance summary sheet right in front of your eyes, okay? If you violate it and you wind up making less money than you're supposed to, or you take losses where you're not supposed to, it's there, staring right at you. People on the floor would always rationalize why they lost the trade. It'd give you excuses that the next time they were going to take care of, but the next time there was a whole new set of excuses. And it just didn't seem like their theories were moving them forward at all. It seemed like they were trying to punch their way out of a paper bag. All right, so you're getting to the point where you want to do this right. You want to create your own systems. There are things you have to adhere to be successful. First of all, this is obvious. You need to know that your data and tools are reliable. I use TradeStation data and their platform to trade. I consider it good, not perfect. I haven't found anything that is. But I can tell you that there is nothing in AI that is hopeful yet. And I'm sure there's a lot of rinky-dink stuff out there that you want to stay clear of. Choose a market that has both good liquidity and volatility, particularly if you plan to day trade. Liquidity means there's a lot of participation in the market, and you're likely to get fills that are at or very close to the ones you project in your performance summary. That's very important, okay? It's a constant game of your actual trade has to approximate what you projected in your research. If you have an illiquid market and you're giving up ticks on every trade, your performance is not going to resemble the results that you projected. Also, the market should have volatility. Okay, winning trades are market going from here to there. You don't want that to be too narrow. Too narrow action in a market is a dead market. You need it to be active enough and the ranges to be wide enough for you to be able to exploit and profit off them. Make sure that your testing field is large enough and that it incorporates a wide array of market environment. Okay, it stands to reason that you're going to be making money on the long and the short side if all you've looked at in your data field is 5 years of a raging bull market. You're not seeing what you can expect in a bear market, sideways chopping market, etc. So you have to, do a look back, make sure that you're getting a wide enough example of what the markets are going to do. You have to know where the theoretical world diverges from the real world trading. Very simple example is limit orders. TradeStation, and I assume the other platforms also, will count every time that a market hits a buy order but does not go lower through it, or every time it hits a sell order but does not go higher through it, as filled orders. They're not filled for most of the people participating. Just remember, your order is one of many competing orders, and most of the people that are trying to buy a price that is the extreme price, the extreme low if you're a buyer, the extreme high if you're a seller, are not going to get that price. So you have to know that your real world expectation is going to be different than your performance summary as far as limit orders. Close orders that are price targeted, doing something on a stop or a limit order on the close, that's not going to be realistic if you're automating it, because the closing price is not determined until an instant after trading stops. So you need to know things like that. Understand your drivers and test only in support of theories or concepts you believe to be true about the markets. I'm going to give you 4 rules of prudent optimization. Okay, rules 1 to 3 are going to eliminate, are going to mitigate, I should say, missteps, deceptions, etc. In your testing, but they're not going to catch everything. The 4th rule is that you have to know that your trade is not silly. I'll give you an example. You can make a system. I've done it. I've shown them where you make like 130 profits on no losing trades whatsoever. 130 winners, $300 a trade, no losers. I do it by simply, it's an S&P system. You buy, you pick a number, after the 30th, the lowest close of the last 30. And the trick is you don't put a stop up, you never take a loss, you just take a $300 profit, 6-point profit. Well, the S&Ps, as you probably know, are a continuously upward sloping market. Crashes and present time accepted, of course. But they will, they will recover. They always do, and you're just jerry-rigging the system in that direction. So the point is, that's just an absurd system. But a lot of the misleading stuff is not so easily identified. So if you're looking to test a system based on momentum or mean reversion, off support and resistance. Know that going into it. One of my books, I asked all the traders, would you just trust really good looking numbers, or do you have to have a theory, a reason going in behind them? And I expected I might get some answers in both directions, but no, it was unanimous. Know something about what you're trying to do going in. Don't include the last year of data in your initial testing. We're working with the past at all times. What else do we have? I said that to my wife recently when she was questioning, well, you know, you're going to have a winning this or that just because you saw it happen in the past. What else do you got? Okay. But by withholding a period of time out of your data field, and you do all your jerry rigging, weighing, balancing, changing numbers, optimizing, and then you apply it to a period that had nothing to do with that process, you're pretty much creating a virtual future. Initial testing should be wide to find a frequent bias. In other words, don't start out with your stops and your filters and your other qualifiers. Let's not let a bias get away from us, okay? And from there, narrow in with additional rules, stops, and filters. You'll be, in this process, improving your numbers. The paradox is you'll be making the prospect of over-optimization more likely. You've just got to like have a balance between the two. You can't go too far into over-optimization. Make sure that you have enough trades for statistical significance. This is different than having a suitable number of market environments. You have to have a number threshold where there is statistical validity. I always work with hundreds of trades in my performance summaries, sometimes thousands. Design your systems with variables that can be optimized. Okay. In other words, instead of a number, you got an N or an X. And you ask, what if this number was 1, 2, 3, up to 20? You do an optimization study and it'll spit out 20 results, one atop the other. And you can weigh and balance and know which one you're going to settle on. But you're not going to automatically take the best number, okay? Your results should reside in a neighborhood of similarly good numbers and not be a standout diamond in the rough. If it is, if 5 is your best number, but 4 would have produced a losing performance, 6 was just kind of blah, etc., then go to your second best. Go to your third or fourth best if necessary. Add slippage commission to your settle on strategy. Okay, for me, I like to do $20 round turn. That's a little more than 1 tick plus commission. Test the system with data you withheld from the past year. We're going to that virgin data, okay? Should hold up reasonably well. Might not be as good as what you projected. It's understandable, but you want to see it holding up somewhat reasonably well. The return on account is the best measure of a system, but all components of your performance summary should range from reasonable to exceptional. Return on account is your net profit divided by your worst drawdown. That gives you a percentage that you would have enjoyed, percentage of gains, had you started with your worst drawdown amount. Examine your trade list and periodical returns to make sure your gains are dispersed more or less evenly throughout the data field. You can devise a system that has very good performance that occurred like in a 1 or 2 week period. It's got you in the short side and a market crash. Immediately after, there was a violent V-shaped rally. You got long there. You're showing a $50,000 profit off these anomalies. What did the rest of your performance do in all the other time frames, all the other years? Well, it put and it took, put and take. Not much of anything. That's useless. I came in short Black Monday. I came in long on 9/11. You could just as easily be wrong as right on the next anomaly. We're not playing for anomalies. We're playing for, all your wins and losses of a large number of trades thrown into a hopper together. So when you do your look back, of course you're going to find losing periods, but winning periods should be fairly smoothly periodical. They should be in there, not in one bunched up place. Look for similarly positive results in other markets, particularly closely related ones. Okay, I won't do an S&P system that blows up in the Dow or the NASDAQ or the Russell or even the mid cap, which is too illiquid to trade. I'd also like it to, I'd feel better, I should say, if it worked in the bonds also or the currencies. Don't necessarily insist on that, but more corroboration is always better than less. I use about an 8-year look back in my research. That's what I insist on, but I'm happier still if it worked 15 years back. More is always better than less. But you especially have to insist that your related markets conform somewhat. An ideal goal for trading multiple systems should be low correlation between them. In other words, don't deceive yourself that you're not just adding contracts to two system ideas that are so similar that you're not getting any divergence to speak of. Have a plan for computer, internet, and technical problems. I trade automated, but I have my my desk in the speed dial in case the computer goes or whatever. Just make all your contingency plans ahead of time. And then, like I did with the notebooks and the library, go back, double check everything. All right. I trade the stock-related index futures. My market is the S&Ps. Best instrument for day trading, again, because of combined volatility and liquidity. They provide a rare combination. Good liquidity means better fills with little slippage, and volatility means bigger ranges, better opportunity for favorable price movement. Right. The testing concept is that a historic data field will let you back test trades from a devised strategy code. If the result is suitably robust aggregate profit, the plan is to actually trade it exactly as it was applied to the data field. Again, that's part of staying disciplined. Any deviation and you're not trading mechanically, and also trading as close to the model as possible, which incorporates knowing where performance projection and actual trade is going to diverge. You will likely have several choices in sizing your system rules. one of the biggest steps will be optimization, determining the best variables for your system. So I want to show you a very basic but very good bare bones system here with some suggestions on how to make it better. Among the most popular of trading methodologies for trend and momentum is the moving average crossover. It's simple to create, can often be traded via mere eyeballing without computation. And here's the thing, if you're a research nerd and you just love seeing results spit out at you, there's just such a large number of ways to create them. Obviously, if you're looking at the size of an average, that can be just about anything. And ways to enter the trades can be varied. And then, of course, you can add other rules, can combine them. Unlike the majority of canned technical tools, moving average systems do work. Okay? I would never suggest that you should go with it because it's popular. Let's call it time tested. It might be a better reason to go with it. What is a moving average cross? When a price crosses through a single moving average line, or when a faster moving average crosses a slower moving average. The moving average that has less number of bars in it is going to tend to be the one you're going to be going with relative to the one that has more bars. Obviously, a shorter moving average is going to have more immediacy when a price changes direction. When a market changes direction, it's going to be the smaller one that is going to move faster. That tends to be the go with one. As price passes through a moving average or has a faster moving average, let's try that again. As price passes through a moving average or as a faster moving average crosses a slower moving average, you get a visual representation of momentum. So here's the simple moving average crossover I promised you. Set your chart to daily bars, day session only, 8:30 a.m. to 3:15 p.m. Central Time. And of course, I know that the market does not stop trading at 3:15, but it's still considered a day session from 8:30 to 3:15. So use it, and it's actually good if you're going to like trade. If you're going to go outside of day trading systems and trade intraday, it's good to know that if you make a mistake and you're still in a trade at 3:15 you were supposed to get out of, or you're out of a trade you were supposed to remain in, you can correct the mistake up till 4 o'clock. After the 3:15 close, compute the value of the 4-day average close. If tomorrow's open is below that number, go long 1 tick above that number on a stop. Okay, one of my tricks is I like using stops on entries as well as exits. Make the market prove itself by going in your direction a little bit. If tomorrow's open is above that number, go short 1 tick below that number on a stop. Exit at the 3:15 p.m. session closed. So here's your 4-day moving average, which you'll know at the close of the session for tomorrow's open, which is clearly below that number here. So your entry point is that number plus 1 tick on a stop. Here, the open is above that line, so you go short that number minus 1 tick on a stop. Exit at 315. From 2015 through 2024, the S&P made $75,590 from 938 trades. Just over half the trades were profitable. The average trade was $80. The worst drawdown was $26,525. That's too big to make most of us comfortable, but remember, we didn't put any stops in. And the return on account, which again is the figure that I put the most credence in, is 284%. Means that had you started with $26,525, your eventual $75,000 would have been an increase in profit of 284% of that figure. As I always insist, we have corroboration across the related markets. In terms of that all-important ROA, the best performer for this data bank is the Dow, $40,930 profit, $10,270 worst drawdown, 398% return on account. Another point about the return on account, why I like it better than net profit. You can see here that if you had traded 2 Dows, you would have had more profit than the S&Ps with a $20,500 worst drawdown compared to the 26. So you would have beaten the S&P performance on both ends, profit and risk. That's why the return on account tells you more.
Hey, Art.
All right. Hello?
Yeah, you're getting, I need you to kind of wrap up in a few minutes here.
I'll be quick.
Okay.
Can these numbers be better? What if the system had a stop loss? Okay, I can tell you that on this particular system, stop losses do improve it. What if the entry was more than 1 tick through the moving average? 5 ticks, 10, whatever, through an optimization study, we might find better results that way. What if it specified a minimum distance that the open needs to be from that number, not just lower for a buy, but half of an average range or a full average range? What if the system added a second condition or a third or a fourth? What if all the variables were re-optimized, including the number of days in the moving average? Okay, review of prudent optimization. Make sure your best result resides in a neighborhood of similarly good numbers. You don't want to act off a standout diamond in the rough. System results should hold up in other markets, especially closely related ones. Profits and losses should be dispersed somewhat evenly throughout your data field, and understand your drivers. Test only in support of theories, concepts you believe to be true about the markets. Okay, real quick. Take this into your lab and you might be able to actually get these results. This is the S&P. I altered the rules. Came up with a $1,300, I'm sorry, 1343% return on account, 13 times the $3,800 drawdown. Different set of rules. Gave you this in the Dow, 44,000, 5260 worst drawdown, 839% return on account, and then the NASDAQ, another 1,300% return on account. All right, I appreciate everybody joining me. I don't know if we have time for questions. Quick takeaways. Backtesting mechanical trading bypasses emotions, psychological wiring. Anyone can backtest their own ideas. Simple systems are tradable and robust. Follow the 4 rules of prudent optimization.
All right. Hey, Art just wanted to plug his YouTube channel. guess it has 150 systems on it. Link right there in the chat. Oh yeah, Art, maybe one more click here on your screen. All right, there you go. So that's the YouTube channel. Also, it's in the chat, and it'll go out with the recording. So Art, we want to thank you for joining us.